Hello and welcome to Livewire Markets. My name is Chris Conway. Today I'm speaking with Eric Souders, who's the Managing Director at Payden and Rygel. He's going to be talking to us about the firm's unconstrained fixed income strategy. Eric, thank you so much for sitting down with Livewire today.
Thank you, great to be here.
For those who don't know Payden and Rygel, for the Livewire audience meeting you for the first time, Eric, tell me a little bit about the firm's DNA.
Payden, over 40 years history now, founded by a woman named Joan Payden. Really rooted in active management, active fixed income management, believing that we can add value for our clients through global fixed income. So very global in nature, the firm, which is why I'm here in Australia with you today. Institutionally focused, right? So the majority of our clients are institutional, Fortune 100 type companies. We do have a retail footprint at the firm as well, but very much institutionally focused. And I'd say for us, really, the emphasis for us is partnership with clients, customization, trying to understand what their needs are, growing with our clients over time. We really take pride in that. So I think it's active management, and then it's adding value for our clients in various ways as their needs inevitably evolve.
Eric, I've read the firm's latest research note. It describes today's backdrop as one economy and three cycles. Just unpack what that means and how it's impacting portfolio construction today.
A year ago, the talk was about recession, and I think today the talk is more about concentration. Right, so a year ago, there was a variety of different policies from the U.S. administration that were headwinds for growth. Right, so the concern was, hey, these aggregate policies were going to create some sort of contraction in the U.S. economy. That obviously didn't happen. Growth has remained resilient. The consumers remained resilient. But here we are today, 12 months later, the labor market is weakening. Right, it's softened quite a bit. Wage growth has come down, but we have this offsetting dynamic, which is AI and the capex associated with everything going on, from AI to infrastructure to really kind of the industrialization of the world, namely the US. So the one economy, three cycles is really kind of born out of this 12-month experience, which is you have early cycle dynamics in AI, capex, all sorts of infrastructure spending, to the degree that we haven't seen in decades. So that's early cycle. You have mid-cycle features, labor market cooling, wage growth cooling, consumer cooling. And then you have some late cycle elements as well, where certain parts of the leveraged loan market, just more discernment from investors in terms of winners and losers. So certain parts of the leveraged loan market are under pressure in terms of price action, financing, things of that nature. So we're kind of thinking about the economy today in these three distinct pieces. And I think that the bottom line for us is dispersion. That's really that's kind of the through line across those three cycles. Is we think we've entered a period where it's less about market beta and directionality, and it's more about dispersion.
Yeah, I'm glad you added that, because that was going to be the next question. How do you think about it? What lens do you apply? Eric, we'll talk about the unconstrained approach for the fixed income product. How is that different over traditional benchmark aware fixed income?
We remove the traditional benchmark from our approach, and I think that benchmarks can certainly play a great role in clients' portfolios, but they have distinct methodologies, and in some instances have been around for decades. So to a reasonable degree, some of these benchmarks have not really evolved consistent with broad capital markets, broad fixed income. So for this particular strategy, we like the flexibility of not being tethered to a specific benchmark that has characteristics that we have to manage to. So it just gives us more latitude, to think about portfolio construction, interest rate risk, credit risk, currency risk, kind of setting aside the traditional benchmark framework to say, hey, that's fine. Some of these risks will obviously be embedded in our portfolio, but we don't necessarily have to incorporate that type of tracking or think about it to that degree. So I think it just gives us more flexibility, expands the toolkit a bit, and makes us a bit more dynamic.
Just, I'll pull on that thread there, expanding the toolkit. Just explain, some of the extra tools that you might get from that freer approach, if you will.
Sure, so I'll maybe contextualize it. So the global aggregate benchmark, right? The global ag has been around for decades. And that benchmark is going to contain quite a bit of government bonds, most of those developed, agency mortgages, investment grade corporates, effectively has no below investment grade exposure, very little emerging markets, and then very little securitized credit. And securitized credit is a is a wide swath of different opportunities, from asset-backed securities to commercial mortgage-backed securities to residential mortgage credit to CLOs. So that benchmark effectively contains none of that, very little to no emerging markets, and then no high-yield corporates or bank loans. So, and those parts of the market, by the way, have grown dramatically the last 10 to 20 years. It's an older benchmark construct that is, again, just not, the methodology is not changed consistent with global capital markets. So we can utilize all parts of public fixed income to really identify areas of opportunity, irrespective of what's going on in that benchmark.
Let's go the other way, Eric, and talk about where the real edge comes from. So you've got a broader perspective, and bringing in emerging markets and securitized credit and things that aren't in the benchmark like you're talking about. So you've got to manage those, and then how do you drive that into an edge for, again, end users and people who invest money with you?
I think our edge is credit research as a firm. And I think an area like emerging markets you mentioned, that's a great example. Our emerging markets team has been around since the late 90s. I think you'd be pretty hard pressed, to find many firms that have 25 to 30 years of experience in emerging markets. That area has grown tremendously. 10 to 15 years ago, there were only 10 countries in the emerging market index. Now there's more than 80. We can find opportunities in these more niche areas like EM that I think fit well in certainly an unconstrained portfolio, but really across the platform at Payden for different types of mandates. Credit is where we have edge. How we put those pieces together to really add value in this portfolio, thinking about cross-asset relative value, cross-asset fundamental directionality, cross-asset flows. I mean, that's been a big theme the last 6 to 12 months. For us, we were thinking about the direction of travel of capital flows really at kind of the back half of 2024. We had seen 3 straight years of outflows from emerging markets. We felt like the world was, and to a large degree still is, overweight public credit in the US, private credit in the US equities, and very underweight EM. So I think it's identifying things on a cross-asset basis, but also bringing it back to the roots of the firm, and really where we think we can add value is overarching credit research.
Let's just go a little bit deeper on emerging markets, Eric, because I know it has been a high conviction call for you. So you talked about the rest of the world not paying attention to it. What do you think they're missing? What do you like, and what do you think they're missing?
I think EM is, it's been viewed as a bit of a monolith historically. It's like it's China, and then it's everything else. Yep. I think one really interesting part about this current cycle is China's not doing great, but EM is doing quite well. So I think some of it is just the belief that really China is going to dictate how EM performs, which 5 to 10 years ago would have been much more true than it is today. We like a variety of different things that are going on in EM right now. There are elevated real rates in EM relative to developed markets. Why is that? Well, partially because emerging market central banks hiked rates before developed markets in this latest inflationary cycle, 2022, 2023. They did that because they know what inflation does to their currency, to their economy. So they got ahead of that. So real rates are elevated, inflation is contained, and this AI capex driven cycle that we've talked about, the one economy, 3 cycles, it's a big tailwind for EM. Why? Because EM controls commodities, natural resources, and the world is going to need that, right? This AI driven capex, the industrialization of the world, big tailwind for EM with respect to commodity and resource control. And by the way, valuation looks pretty good, and I'd say the kicker here is what we would describe as a technical tailwind, which is, I've already said, the world is underweight EM, the world is overweight credit in the US, the world is overweight US equities. And so if the world is overweight US credit and US equities, they're really overweight the same factor, which is the US consumer, but even more narrowly, tech. Right? So the world is overweight tech, the world is overweight the US consumer. EM does not face those things directly. So it's a really interesting form of diversification in portfolios. You don't often think of EM as a big diversifier. You think of it as a bit more idiosyncratic, but I think you put these pieces together, it looks quite compelling here.
Yeah. Question without notice, Eric. Geographically, regionally, country-wise, what do you like in EM right now, and maybe some of the stuff you're avoiding? Obviously, you talked about China. Maybe that's yesterday's story. What do you like right now?
Yeah, I mean, I mentioned that, over 80 countries in terms of our coverage in the emerging markets world. So there's a lot to think about. EM is still an idiosyncratic asset class. So there are fatter left tails, if you will, in EM at times relative to DM. more social unrest, more governance issues. So we have to really kind of keep these things in mind. There are a couple examples that we like. Nigeria is actually a great story. This is a reform story, government reform story, pro-business government there. Fiscal situation has improved dramatically. Inflation has come down significantly. The government seems to be doing the right things. So for us, I think the direction of travel around governance in EM is big. Nigeria is a high yield issuer, so a bit higher beta, but we like Nigeria. Romania is another good example, but Romania is an investment grade issuer, NATO member, proximal to the European Union. Again, inflation has come down significantly. Fiscal side of the house looks quite good. So I would say, on the investment grade side, Romania looks good. On the high yield side, Nigeria looks good. South and Latin America as well, just to maybe give you a broader regional theme here. South and Latin America, just given the proximity to the US and Canada, the strength of the partnership that we think will persist and probably grow stronger from a trade standpoint with North America, we think is key. So we like certain parts of South and Latin America as well.
Eric, talk to me about downside protection. How do you think about it when credit spreads are tight and leadership is narrow?
Fixed income is an asset class, right? The starting point of fixed income is important, particularly when you're investing in credit. What are you doing when you're investing in credit? You're really underwriting downside. You're not necessarily underwriting a lot of upside, typically. So the starting point, the arrangement versus the equity market is quite different, right? Equities, you have unlimited upside. Fixed income, generally speaking, you don't. So we're always thinking about this left tail and what does that credit downside look like? And that's where I think, I mentioned our edge is in research, and I think, distribution of outcomes, particularly today in areas like tech and software, where it seems like the story is changing week by week, if not day by day, in terms of these business models. What are things going to look like? Our mentality around underwriting downside is key. Incorporating things in the portfolio that can be more resilient, right? So shorter maturity bonds tend to be more resilient from a price standpoint than longer maturity bonds, right? So we tend to emphasize a shorter maturity profile on average, gives us a bit more resiliency. And then using derivatives periodically, whether it's options or credit derivatives, to just protect the portfolio. And I think, the situation in Iran now is probably a good example of where you want to think about these factors, downside, and how to incorporate protection in a particular mandate.
Yep. Eric, talk to me about the US dollar. Has a massive impact on things like emerging markets. How are you thinking about it as it impacts the portfolio today?
Yeah, the US dollar for us was one of the reasons why we thought EM could perform well really the last 12 to 15 months. That has happened. It was clear to us at the beginning of 2025 that the Trump administration was open-minded to a weaker dollar as they were looking to become more competitive from a trade standpoint. And again, when you think about just zooming out the broad setup, world is overweight US assets. World has largely been long the dollar, right? So if you look at hedging globally, the amount of hedging with respect to dollar assets is at cyclical lows, cycle lows. So if the world is overweight US assets and the world is hedging the dollar less, then the Trump administration wants a weaker dollar. You put these pieces together, and for us, it seems like it could lend itself to a weaker dollar. And so EM obviously benefits from a weaker dollar. EM FX stronger, that helps their terms of trade, helps their capital account, helps financing, less external reliance, things of that nature. So a weaker dollar for us was a big part of our EM thesis. And I think it's really more about the second order effects rather than just dollar stronger, dollar weaker. It's what impact does it have on commodities? What impact does it have on the financing arrangement of other economies, not just developed but also emerging markets?
Eric, last one for today. For Australian investors already holding domestic bonds, what role can an unconstrained global strategy play in a portfolio?
We talked quite a bit about the global kind of capital arrangement, portfolio construction thing. So I would encourage viewers to just think about what role does fixed income play in their portfolio, right? What role does interest rate duration play in their portfolio? In an environment where inflation may be a bit more elevated than it was in the 2000s and 2010s, the role that duration plays as a complement or an amplifier to equity risk and credit risk might be different. So I think we should be open-minded to what these factors look like today relative to prior periods. I think the unconstrained strategy is compelling for investors, because if our thesis is correct, which is the current environment is likely to exhibit more dispersion, and we're likely to experience that in the next 6 to 12 months, which that is our base case, you want more flexibility, right? Flexibility is your friend relative to being beholden to a particular benchmark that might give you a little bit less flexibility. Again, investors should think about the role that bonds play, the role that duration plays within their broad portfolio, and consider how a strategy that doesn't have a benchmark gives them a bit more latitude.
Eric, thank you so much for sitting down with Livewire and taking us through the firm's unconstrained fixed income strategy. It's been a real pleasure.
Thank you very much. Great to be here.